Welcome to the deep dive. Today, we're taking on a really spectacular case study that you, our listener, sent in.
Yeah.
We're looking at a company called Hyperscale Data. The ticker is GPUS. And it's operating in two of the, most complex and, frankly, volatile sectors you can imagine.
At the same time, you've got cutting-edge AI infrastructure on one hand and digital asset treasury management on the other.
It's a wild combination.
It really is. And the sources we have, articles, corporate filings, technical data, they paint this picture of a company trying to solve a very modern problem.
Which is?
How do you finance a huge capital-heavy tech build-out without going the slow, traditional debt route? And their solution is, let's just say it's unconventional.
Yeah, let's call it the Bitcoin-backed AI cloud strategy. And that's our mission for this deep dive. We're going to unpack this whole dual mandate.
Right. We have to synthesize the high-flying ambition of building an advanced GPU cloud.
Which is a massive future market if you can pull it off.
Exactly. Synthesize that with the sobering reality of their financials and just the massive risks baked into the model.
And the risks are really colliding here.
Oh, absolutely. You're wrestling with two huge non-trivial risks simultaneously. First, the existential volatility of crypto, where your main asset can just drop 50% in a few weeks.
Right.
And you're mixing that directly with classic operational microcap business execution risk. If one side fails, the other side offers, well, basically no protection.
That dual risk is exactly why the market is reacting the way it is, which we will definitely get to. But first, let's start at the beginning. What exactly is Hyperscale Data trying to build?
Okay, so Hyperscale Data's whole strategy really centers on its subsidiary, Centimer. The goal is pretty clear. They want to launch an on-demand, high-performance GPU cloud platform. They're aiming right at the explosion in demand for HPC high-performance computing and, of course, generative AI.
We hear GPU cloud a lot these days, but maybe for you listening, what does that actually mean? In terms of the sheer complexity of it.
Yeah, it means you're competing in the deepest end of the pool. To serve modern AI models, you don't just need some cheap servers. You need extremely advanced, very specific hardware.
Like the NVIDIA chips.
Exactly. Think NVIDIA's A100s or the H100s that everyone wants. These things are scarce, they are incredibly expensive, and they require specialized infrastructure power, advanced cooling, often liquid cooling, just to run.
So this isn't just a CapEx problem. It's a huge technical and engineering challenge. It requires a ton of investment and expertise right up front.
Precisely. The barrier to entry is immense. The costs are all front-loaded. You have to spend a fortune on equipment before you even sign your first customer.
And that's why the financial strategy is so critical.
It's everything. Which brings us to their backstop, the digital asset treasury or the DAT strategy.
Right. They have committed to building a $100 million digital asset treasury. This isn't just, a side bet. It's a core strategy.
Oh, it's fundamental. The long-term goal is nothing less than to accumulate Bitcoin equal to 100% of the company's market cap.
So if they pull that off, the value of their Bitcoin holdings would mathematically equal their entire public valuation.
Yeah, that's the ultimate goal, to create what they call an asset value floor.
The pitch being, even if the AI cloud takes longer than we think, this underlying asset base protects shareholders from, well, total disaster.
That's the theory. And what's so fascinating is the tension that this model creates. On one hand, yes, it introduces all this crypto volatility, which, scares off traditional investors.
Sure.
But on the other hand, if they actually hit that $100 million mark, it provides a measurable hard asset floor. It could potentially mitigate the operational risk of building that crazy complex cloud.
Hold on, I want to push back on that a little bit. If the AI build-out hits major problems, like, say, a competitor forces them to slash prices or they can't get the chips for months, does an asset floor really protect the company?
That's a great question.
Or does it just become a piggy bank for creditors?
And I think the market has answered that question pretty clearly through the stock price. The mere existence of the floor isn't enough. The market is questioning their ability to manage both things at once.
Building a cloud platform.
Right, building this incredibly advanced, complex cloud while also acting as sophisticated fund managers for a super volatile treasury. It's like two demanding full-time jobs under one roof.
Okay, so let's shift from the ambition to the actual metrics. The sources have the hard numbers. Let's zero in on the filings for November 30, 2025. This shows how serious they really are.
The sources are fantastic here. Their total Bitcoin treasury value, and this includes Bitcoin they hold, plus cash committed for future buys, stood at $72.25 million.
72 million. Wow. And what percentage of the company's size does that actually cover?
Well, at that time, based on the stock price and Bitcoin's price, that figure was about 83% of the company's total market cap.
So they're already most of the way to that 100% goal. This is not a casual thing.
No, it's a fundamental treasury decision.
So let's break down the actual Bitcoin they're holding. What did that look like?
Okay, so they held 421.67 Bitcoin. The filing valued that at $38 million, but that was based on a Bitcoin price of $90,394.
That's an important piece of context. It's a high valuation.
Very high. It adds a lot of sensitivity to any price changes since then.
Where do they get all that Bitcoin? They're not just mining it, right?
No, not at all. They're being very proactive. Only about 59 Bitcoin were mined. The huge majority, 362 BTC, was bought on the open market.
I saw that in the notes. They bought almost 34 Bitcoin in the last week of November alone.
Yeah. That signals really aggressive, systematic accumulation.
Which means they are actively choosing to spend their cash on Bitcoin instead of, say, more GPUs right now. How much cash do they still have set aside for this?
They have $34.25 million in cash, specifically allocated for future Bitcoin purchases. It's earmarked.
Okay, but how are they managing the risk of deploying that much money into something like Bitcoin? You don't want to just dump 34 million in at the peak.
No, and management was very clear about this. They're using a dollar-cost averaging strategy, a DCA strategy.
Right.
For anyone listening who's unfamiliar, that just means spreading your purchases out over time at regular intervals, no matter the price. It's a professional way to mitigate that short-term volatility. It suggests real discipline.
So, okay, we have a disciplined treasury, 83% of its asset goal met. They're going after a huge AI market, and yet the market seems totally unconvinced. This is where the story gets kind of paradoxical.
The skepticism is just brutal. You see it in one number, the stock price. The 52-week high for GPUS was nearly $10.
And today?
Today it's trading around 29 cents. That's a collapse of about 97% from its peak. That kind of drop just screams distress, no matter what the balance sheet says.
It's completely disconnected from the asset value. Let's really connect those two things, because that gap is the whole story here.
Absolutely. So you look at the recent filings. Estimated total assets are around $330 million, with net assets, that's assets minus liabilities, at roughly $150 million.
And on a per-share basis.
That $150 million in net assets works out to about $1.02 per share.
Wait, say that again. I want to make sure everyone hears this. The company has $1.02 in net assets per share.
Correct.
But the stock is trading at 29 cents. That is a 73-cent discount to its own book value. Why? Why is the market not closing that gap?
That is the multi-million-dollar question, isn't it? The market is valuing the company so far below its stated asset floor because it's pricing in an almost certain chance of severe future dilution or just operational failure.
So investors are looking right past the assets that exist today.
They are, and they're focusing on the crushing execution risk, which is all tied to the company's history and its microcap structure.
Let's talk about those microcap risks, because they can be the silent killer. The sources mention high volatility dilution, liquidity. What does massive dilution actually look like here?
Well, here dilution is like an existential threat. Remember the main problem. Building an AI cloud needs hundreds of millions in CapEx.
Right. That 34 million cash won't even scratch the surface.
Exactly. So if the company needs to raise, say, $50 or $100 million and their stock is at 29 cents, they're forced to sell an insane number of new shares. It's often called toxic financing.
So to get the cash they need, they might have to double the share count, which would basically cut every existing shareholder's piece of the pie in half.
Precisely. Regardless of the $1 NAV, the fear is that they have to destroy shareholder value today to fund growth that might not even happen tomorrow. The market isn't waiting for it. They're pricing it in right now.
And that explains the 97% collapse.
It explains everything. It explains why that asset floor feels totally meaningless to an outside investor.
It's not just about the crypto volatility then. It's the structural need to burn current shareholders just to feed the CapEx beast of the AI buildout.
And that risk, that operational risk, just overshadows everything else. The market is screaming that it doesn't believe management can navigate this without massive shareholder pain.
Which brings us perfectly to the technicals. Even if the fundamentals suggest an asset floor, the charts track investor sentiment. And right now, that sentiment is toxic.
The technical data is just a giant flashing caution sign. The price, around 29 cents, is hovering dangerously close to the 52-week low of 20 cents.
And the momentum indicators.
The consensus is a strong sell on both the daily and weekly views. You see all the classic bearish indicators. The short-term moving averages are way below the long-term ones. Downward momentum is just locked in.
What about key levels people should watch?
Okay, so resistance, the ceilings the price needs to break through are near 37 cents and then 43 cents. Those are big hurdles.
And on the downside?
The crucial support levels are down near 18 cents and then 12 cents. And if it breaches 12 cents, the risk of a catastrophic decline towards single digits goes way up. That would signal complete market surrender.
So the technicals are basically saying that the asset floor strategy is completely irrelevant to the price right now.
100%. It's all being driven by short-term sentiment and this overwhelming fear of more dilution. The technical picture is stuck until some profound external catalyst appears.
And what would that look like?
Something huge, like they announce major user deals for the cloud or a massive contract with a hyperscaler, something that proves the business model actually works. Until then, the weak chart overrules the strong balance sheet.
So let's distill this. What does it all mean? You have a company with a structured, disciplined asset strategy.
Right. 83% of its market cap covered by Bitcoin, a stated net asset value of $1.02 per share. And yet it's priced like a deeply distressed microcap at 29 cents. It's suffered this historic 97% collapse because the market thinks the operational risk and the threat of dilution will just wipe out that whole gap.
The tension between the balance sheet and the business model is the entire story.
It's the ultimate lesson, isn't it? The difference between asset value and execution viability. Assets don't mean a thing if the company can't survive long enough to use them.
Which leaves you, the listener, with this final thought to chew on. Given the company's very clear commitment to mitigating risk through DCA and their pursuit of this incredibly valuable AI GPU market, how much weight do you give the intent?
The $100 million goal, the $1.02 NAV.
Exactly. How much weight do you give that versus the cold, hard technical reality, the strong sell signals, the near certainty of execution-driven dilution? What kind of catalyst could possibly bridge that gap and convince investors that the risk is worth it? That is the question hanging over GPUS right now. Thank you for sharing these incredibly detailed sources with us and letting us take this deep dive.
Yeah, this was a fascinating one.
We'll catch you next time.